Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. The fourth quarter of 2020 kicked off this week, highlighted by the September jobs report on Friday, October 2nd, and of course, the spread of COVID-19 in the White House. Joining me for a macro look in how investors should be approaching the remainder of the year is John Lynch, Chief Investment Officer at Comerica Asset Management. John, welcome to Trade Talks.
Thank you, Jill.
All right, and we certainly have a lot to cover with the President and First Lady contracting COVID-19. As if we didn't have enough uncertainty and chaotic headlines to contend with, what does the line of succession look like, and will it impact the elections?
Well, it's going to impact investor sentiment, consumer sentiment, potentially voter sentiment if this thing persists. If the president has anything close to what Boris Johnson experienced, I think that will really weigh. If it's a mild case, if you will, I don't want to appear dismissive of that, but if it is more of a mild case with mild symptoms, this could go away pretty quickly. But from a line of succession, people are going to have to check on, Vice President Pence's condition. Then Nancy Pelosi is third. And they'll also want to look at Joe Biden for his health, because they were relatively close on, certainly not warm close, but they were close on Tuesday night.
Well, part of the issue there is it's not like you could be together on Tuesday night and then go for a test on Thursday. It typically takes anywhere from a week, from my understanding, based on the science that I've been following in financial media, that it could take anywhere from 6 to 8 days. So you might get a negative today, but it might not be visible in your system until early next week. So I think we have that issue. I guess, John, the only silver lining I can think that comes out of this is perhaps we'll see more mask compliance going forward, and that will help to eradicate a portion of this. We get a vaccine and we kind of get back, the economy back to somewhat of a normal.
Exactly. Yeah, it's not lost on investors this next week or so. I mean, investors will be nervous and jumpy until we really get clarity. And to your point about masks, absolutely. I've flown twice in the past week or so, and I was very encouraged by how everyone behaved on the planes. Everyone was compliant.
Yeah, well, that's good. It's not that hard. It is not that hard to put on a mask and go from your home to the store. And, if you're in an enclosed area that has been quarantined, just wear it to go into the store for a few minutes. It's not that hard. But let's talk about the hard data that we know is out there now. And we'll start with the jobs report, right? So it's not showing a trend of accelerating in jobs. So, and we haven't seen the Disney layoffs or some of the other layoffs hit yet. That'll come out for October's report.
That's exactly right. So the 660 or whatever the number was in that range, it's curious that that's a disappointing number when you think about, what that number would be in the context of history, just not the last 6 months. So the disappointing number there did weigh on investors initially, in addition to the president's health condition. Yet I think it's important to look a little deeper into that report. The unemployment rate fell to 7.9%, which, again, ordinarily would be rewarded by investors, but we have permanent job losses, and we had a decline in the participation rate. So when you factor all those in, I don't think the report is as rosy as initially, at least the unemployment rate would suggest. And there's something that's been bothering me also relative to the weekly claims report. We all were very pleased yesterday, we as an industry, that we saw only 837,000 as opposed to, I guess it was 871,000 the week before. Yet if you look on the very bottom of page 4 on the weekly claims report, shows that there are over 26 million people receiving some form of state or federal continuing unemployment insurance or continuing benefits. So I think that report, I think, is more reflective of what's going on, and not necessarily. We've gone from 22 million unemployed to we've recovered maybe 10 or 11 million of those jobs over the last 6 months. But there's an underlying threat, I think, to the economy that I'm not sure every investor appreciates.
As companies are focused on employee retention and business continuity in 2020, I would imagine what's going to happen in 2021, management teams are going to look to right-size the business, turn their attention to costs, employee retention, and focus on profitability. Surely that will only add to unemployment concerns. How much stimulus can the Treasury continue to inject in the system?
Yeah, well, today's unemployment report is clearly a signal to Washington that they're not done yet, whether they think they are or not. Today's jobs report clearly states that more is necessary. which is kind of fascinating since we're going to have deficit spending of approximately 3.3 trillion this year. I think phase 5 of the stimulus package needs to be accomplished, and I think today's report clarified that, and it's conceivable we do see something now, particularly with the president's health situation.
You also noticed in your weekly report that there's increased demand for the US dollar, which has been counter trend thus far in 2020. Why is that happening, and how is it impacting commodities?
Yes, we saw a bit of a bid for the dollar in September. That is, since the last couple of days, we kind of gave that up. But the DXY, as I look at it, the trade weighted dollar basket, we saw that sort of gain some strength. And, you can attribute that to the lack of a fifth phase of stimulus. It's seemingly the dollar turned once gridlock emerged in Washington. So I thought that was kind of curious. But longer term, I am very concerned about the dollar. There was a bid for about 3 weeks there that I thought would be encouraging, but it didn't prove. And I don't think it's going to prove when you think about budget deficit, trade deficit, the Federal Reserve that's committed to near zero for 3 more years, and then further fiscal spending. None of those are dollar positive. So I think you're still going to see a weight on the dollar. The only thing the dollar has going for it is that the global mature currency, if you will. So to some degree, there'll be a bid for us in spite of our spending profligacy. But nonetheless, I still think there's going to be a weight on the dollar going forward.
All right, so John, as an chief investment officer, you're dealing with not only health in the White House, vaccination progress. We have a national election, and even with that, we don't know what debates and rallies, or if it's going to be a virtual, how all that's going to look. You also have third quarter earnings around the corner. So what's your outlook for Q3?
Yeah, Q3 earnings, we were down about 30% in the second quarter, and we're probably going to have a Pyrrhic victory with only 20% earnings losses in the third quarter. So I think, the third quarter can really be, I don't really think investors should necessarily focus on what the actual number is for the third quarter. I think this year, to some degree, from profitability, is kind of a wash. I think what investors really need to see is what are the CEOs and CFOs saying in their analyst calls, and is there improved guidance for 21? And I think that's something investors need to focus on, because we're going to see very poor sector performance from energy, industrials, the financials, consumer discretionary this quarter. But oddly enough, absent energy, industrials, consumer discretionary, and financials are the 3 better sectors for earnings growth in 2021.
And finally, I want to get your thoughts on fixed income. As you had pointed out, federal debt and the Fed's policy of low interest rates have made it challenging for fixed income investors. What are the risks in the short and long term should fixed income investors be looking at?
Yeah, it is the most expensive bond market I've ever seen. I've been at it for over 30 years, and it's the most expensive bond market ever. And I just think what investors need to keep in mind is that you want to have some portion of your portfolio within treasuries because of the credit quality, because of the access to liquidity. But I do believe that within the fixed income space, it's going to be difficult. Consequently, the way we're positioning portfolios for our investors is that we want to make investment decisions and buy fixed securities where duration or the interest rate sensitivity is less than the benchmark, where credit quality is above the benchmark. It's really going to be a quality game, and you're starting to see that now when you've seen through September investment grade outperform high yield, and you're seeing that trend, and I think that'll continue. Right now, the high yield market is suggesting something like 7% on a default rate, and that's something all investors need to be mindful of. And to the degree candidate Biden continues to gain traction, and if we do see that increase in capital gains tax rate, it's likely you're going to see an increased bid for municipals going forward.
All right, John, appreciate the insight. Thanks for joining us on Trade Talks.
Thank you, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.